Now let's stay in the AI realm. So here we talked about the ways not to feed junk to AI in order not to get junk as an output. But let's look at a different application of AI and AI agents that seem very attractive, but there's also a big question of whether or not you should let those AI agents have custody over your assets, given that they're full of hallucinations. So Dejan Radic will walk us through this topic. Izvolite.
Thank you for the warm introduction. Well, AI agents and access towards your crypto. Ever since we got algorithmic trading being there and accessing your funds and doing your fund management to you, we have been asking a lot of questions around it. In the last 2 years, I've been working on many, I would say, decentralized AI applications, and accessing the funds and fully managing of them has always been a pretty, I would say, nasty question around it. So, we're going to talk about agents and custody, like two orthogonal aspects of this speech. We're going to talk about authentication of AI agents, regulatory aspects, custody models, market mechanisms, and at the end, multi-agent environments. So A2A protocol of Google came a few weeks ago. So what are AI agents? Basically, if we think about them, and if we want to give them the access to crypto, basically, we want to enable the agentic finance. AI agents basically have 3 components. LLMs, they have memory of the previous conversations for consistency of giving the answers, and they have tools like web search, accessing the database, and so on. So, when they make the trades all together, what do we want to achieve? We want to achieve some level of explainability. So they need to explain us why they are doing these things. And if we as humans want or actually demand to have control over it, how much of our decisions should be embedded inside of the agentic workflow of making decisions. And in general, when we talk about LLMs, we have like many aspects of hallucinations happening. And in case of AI agents managing funds, those can be irrational trades and misplaced trades. On the other end of the spectrum, we have a totally different defined concept of crypto custody, either through mechanisms like private keys or API keys or centralized, decentralized custody, which we are going to talk about. So it's about enabling the operations over your funds. And basically, when it comes to AI agents, it's about them authenticating themselves towards the blockchains to access the funds. So we have regulatory aspects of these, and we have always the question on the custody, where are the private keys, how are they stored? So basically, that can be either a self-custody or a third-party custody. So regarding the authentication, we have 2 ways. Token-based authentication through JSON Web Tokens or like API keys, which are suitable for custodial systems, and private key-based authentication, which is based on digital signatures and novel concepts like agent-bound tokens, which are basically based for suitability of the non-custodial applications. What are the most important aspects when we talk about the managing of funds in this kind of context? When an agent authenticates himself to the system, either through providing the API key and doing some kind of, I would say, challenge response scheme, or by signing certain messages and like relaying them to any kind of blockchain system, basically after this point of authentication comes the step of authorization. And authorization means, like, what can that agent do with our funds? So does he have the custody of all of the funds? Can he access only certain amounts of funds at certain points, and so on? Now, AI agents are still machines, but they need machine level of authentication. Usually when we do the, I would say, multi-factor authentication, It's either based for humans on something humans know, something humans have, or something humans are, so biometrics. For particular usage of AI agents, basically we need to know and we need to rely on something what they know. So AI agents do not have biometry, AI agents cannot possess physical things. So usually, when talking about these schemes, we are talking about requesting some kind of access to the resources, then getting the access to it, and then thinking about authorization further on. Now we see that agents are considered to be pretty autonomous. We do not need to have like high levels of controls over them. On the other hand, they are not physical persons. And can we say that regulatory aspects are actually being brought to the face of light regarding them? And we are opening a lot of questions on responsibility. So can we say that AI agents are in identity crisis? Who is responsible for their actions? Are the creators of the AI agents or the operators of them? So that's basically the boiled down question. When somebody wants to access the crypto funds, the first thing being asked today from the regulatory standpoint is to do any kind of KYC, KYB. So that is also like high-level legal requirement. On the other hand, if we want the utility of AI agents, then some persons is going to be responsible towards all the actions of an agent. Irresponsibly, that can be any kind of thing that the agent does. So we might introduce a new thing towards AI agents from this standpoint. And basically, if we have a proof of humanhood by doing KYC and KYB, why shouldn't AI agents have the proof of agenthood? So right now, if you're a human, you would pass the CAPTCHA test. In many cases, AI agents can still pass some of these, but in general, it's about presenting yourself as somebody who has created an AI agent, and that AI agent can actually operate without any kind of obstacles fully autonomously. So regulatory landscape on both AI and crypto is still being developed. EU is the first, of course, in all of these cases with AI Act, with MiCA. Now combining these two to be able to have operations of AI agents accessing the crypto funds is on a responsibility level is the next step for regulators. Now, when AI agents access the funds, and for example, they are doing it towards the centralized exchange, where we are holding the majority of liquidity, we have the best performance of doing any kind of trades and so on. Usually, we would access some concepts regarding Fireblocks, Coinbase custody, and centralized exchanges, and it can be either through cold storage mechanisms, hardware security models, multi-party computation by Fireblocks, and so on. And all of these are basically centralized systems in which we authenticate ourselves by using API keys or token-based authentication schemes. In the case of MPC, basically, a human can be a controlling point for some trades or some decisions that AI agents are doing. So basically, it's a token-based authentication where parts of the threshold signing can be done by somebody else. On the other hand, if we want to give the private keys to crypto access to the AI agents, we open up a whole new level of questions. It can be a standard wallet where you just keep all the funds on a single address and execute trades further on. It can be hardware wallet, which can be in possession of a certain person who has created, who is operating the AI agent, and AI agent is requesting the signing mechanism which can be approved physically by a person if a person wants a control. On the other hand, we have proxy smart contracts. For example, we want to be transparently open towards what the AI agent is doing to show that our AI agent is the best trading AI agent out there. And we want to execute all the trades fully transparently over the proxy smart contract by also implementing some kind of investment policy, like you can spend 10,000 on a trade, but you cannot invest in anything regarding Monero if that's aligned with our values. So that can be done through proxy smart contracts. Or if we want multiple agents to decide on what the next step would be, that can be done with multi-sig wallet. And of course, account abstraction, which is at first created for people to have abstraction around what we can do with smart contracts. In this case, it perfectly aligns also with the things that AI agents can do. Now, for example, when we want to access the liquidity of any kind of the system, we are always thinking from two dimensions. Usually, centralized exchanges have central limit order book or club, which you access by authenticating yourselves through certain APIs, and AI agents can choose on what kind of action to perform based on, let's say, liquidity depth, based on previous trades, based on the current price, and so on. With the AMMs, everything is transparent, fully visible, like Uniswap style, a liquidity pool with like 2 or 3 or n assets inside, where you know what's the difference of doing the trade there or in some other place. On the other hand, we have request for quote systems, which is suitable for long tail assets, where we would ask certain solvers or market makers and so on to give us quotes regarding the executed trades that you want to relay on the chain and so on. So it's a question of what do we want to achieve. The problems with club is, for example, partial fill. The problems with AMM is the amount of liquidity in a liquidity pool. The problem with RFQ systems is, for example, nobody answers on your trade. I want to swap 1 Bitcoin for $1,000. Nobody would go and give us an offer for that. So basically, we need to think high level. Right now, if we want to create a holistic agent to access all of these, it's not that easy. We need to adapt to different systems. But today, we have the option to use intents. Currently working on near intents, which is a system where AI agents can actually access the funds by utilizing simple APIs and have the access to all of these, where trades are actually executed in behinds by solvers and market makers. Now, single agent is cool, but it has its own limitations. What about mixture of experts, multiple agents having their own domain expertise and so on? So we're entering a new environment, and in the previous talk from Origin Trail, we've seen a lot of things being mentioned from this image in particular. You can track the paper by scanning the QR code about the governing agent-to-agent economy of trust via progressive decentralization from January this year. And it basically proposes the way how multiple agents can execute the environment in a decentralized way, where they can, of course, possess some funds and stake some funds as a proof that they are going to do everything up to certain standards. On the other hand, all of them are having domain expertise. They have a reputation system with a decay of reputation through time, and they have the ability to vote, and with quadratic voting of allocating the votes towards different options in different amounts, to actually run the system where they can decide between each other how these things can be done. And for example, by having multiple agents, one is doing the sentiment analysis, the other one technical analysis, third one the fundamental analysis of the trades, fourth one is searching for long tail options, ICOs, launchpads, and so on. We can conclude about, for example, making some trade at a certain point of day based on some kind of, I would say, touchable information provided by agents. So, AI agents are about utility. We are using LLMs and then autonomy of agents because they are pretty touchable. We can sense the way how they are doing things up to a certain extent. It's hard to have full explainability on one side, but on the other, we really like certain things around them. On the other hand, crypto custody has always been about security. It's always about having the procedures, processes, about keeping the keys, about having layered protection, and so on. So we can say that in security, there is always a security-utility trade-off, and these two are on a counter sides of the spectrum. And basically, by having these two authentication mechanisms, which is like API-based and private key-based concepts, we can access the funds by utilizing different kinds of aspects. And they also align with different levels of custodiality, I would say. One is centralized systems, and the other one is decentralized systems. If we want to balance out the control and autonomy of the agent for some swaps, some trades, some decisions, human can be responsible by, for example, signing an additional signature in a multi-sig, or participating in a threshold signing of an MPC. Custodial and non-custodial moments are pretty tied to the way of centralization, decentralization spectrum that exists regarding these trades. And AI agents are still, I would say, not trusted enough, so the balance of this control is going to be higher right now, but as we move through time, it's going to be more and more. Intents are a pretty good abstraction mechanism of different kinds of market mechanisms that we are having out there to abstract out the complexities of placing the trades in different kinds of systems. And of course, if we want to differentiate on the different kinds of areas of expertise by the agents, we need to enhance the way how we are thinking about agents from the standpoint of multi-agent environments. But it opens up a lot of questions that were mentioned before on this stage today regarding reputation and decentralization. That would be it for this speech. Any questions? No? There is one.
Just a non-serious question. Do you trust any of your financial operation to agents?
Right now, it's on a level of giving advice about the options. So it's not fully autonomous. There is control about, like kill switch decisions. So yeah, it is a pretty direct question. And so far, we are at the point where everybody's thinking about the way how these things are done. And in general, with algo trading mechanisms, you know why certain trades have been executed. With AI agents, you're just thinking from the level of explainability, why they have placed certain things and why these things have happened in some kind of order, and why these, for example, particular trades were directed, for example, liquidity-wise and volume-wise on some parts of the system. So basically, it is a question on, like, when is the focal point of people actually start trusting these agents to manage the funds. So far, from my standpoint, I'm still waiting for the point where the level of hallucination is being dropped down, and we are seeing that happening every day.
And having, just a next question, sorry. Having your experience in this, like AI, finance stuff, what is your prediction? Like how much time, years or months maybe should pass before people start trusting their
Well, to be honest, it boils down to the hardware level of support. We see, for example, with every new LLM coming out, when it comes out, they allocate a lot of power to it. And this power at the beginning for early adopters, they are getting really good results. Then everybody jumps towards this LLM, and then after that, they need to reduce these coefficients of the depth of the search, and then system starts producing some hallucinations and so on. So from my standpoint, it's about solving the hardware problem. And from my view, I feel that in next year, basically, we are going to have pretty good level of, I would say, accuracy regarding all the answers that we are getting. And right now, for example, with AI agents doing the crypto stuff, usually the prompts are much longer than the answers. So it's about summarizing a lot of information from different sources and giving the proper answer. Right now, systems are doing pretty job with it, but till the point that we are 100% sure it is going to do a good stuff regarding our funds, most probably roughly a year, so that would be my prediction.
Yeah, quick question. Are there already examples of agents doing some significant volumes? I mean, has somebody already like dedicated significant amount of funds and those like being seeing like a great, let's say, return of investment?
So far that I've heard of that somebody has been allocated a lot of liquidity to an agent, I haven't heard of. Right now, definitely, there has been advancement with virtuals, with other protocols, and basically from terminals of the truth happened at the end of October last year. We are seeing much and much more shift from just shilling on Twitter towards like fully management of funds. And at this point, like early stage is always like a couple of enthusiasts who put like couple grand just to test it out, but so far not much liquidity has been put on an agent to do it autonomously. Yes.
How do you deal with the security issues regarding the AI agents and transactions between them?
Well, basically, we talked about different kinds of custodial models and about authentication. Authentication is still a layered thing. So you need layered level of protection of your private keys or an API key or accessing the funds in some kind of way. For example, with these concepts that were mentioned here, you can, for example, limit out the ways how things are being done on chain, and then based on authentication and giving the level of access to a particular agent, you can access these funds in a more secure way. So it depends on like what kind of security. In this kind of case, like it's combination of cryptographic and layer security, which are basically, yeah. So basically, if you go towards private key authentication and seed phrases as a concept or passphrases and so on, basically you need to keep it either in hardware security module of a cloud or at your PC and so on. So you're depending on the security of the machine where the keys are.
And last but not least, agents are in open, how to say, and in the end, you have the security breach going to asking agent to get your security keys and everything. You can have that as a problem because the other people build the agents for you that you use. Do you have some kind of thinking about that, how to bypass this?
Well, for example, if you build an agent and you open it up with agent-to-agent protocol and somebody else can use it, basically you need to do it on a prompt level. So it's on a prompting side, and it's about like having the final check of the amounts of, I would say, the accessed funds regarding like executing the trades further on. This has been more from the standpoint of having the autonomous agent run in a safe environment by yourself in order to manage your funds. If you want to open up your agent towards the access by the others, and then others can influence your agent based on certain, I would say, decision-making aspects, that's opening up a lot of questions regarding the system, and that's why this slide was presented where like we need reputation mechanism to actually deal with agents, because if we like give a lot of influence to somebody, basically he can access our funds. So it's as if, for example, you meet somebody new and he tells you, like, invest in Solana, like, are you going to trust him? But if you know him well and you know his expertise, you're going to trust him. So basically, it's similar with AI agents. It's about having the reputation scheme that's general, and where basically we're going to have scoring system about AI agents and their own productivity, their own decision-making and accuracy, and so on.
Okay, I'll leave it at that, but ask a lot of questions afterwards.
Thank you. Yes?
Yes, did you mean that AI agents can become intent-based mechanisms, actually solvers itself, or will they use intent-based mechanisms that exist in the current market?
Both. So if you create an agent to answer to other agents' requests, then you're a solver. But if you're an agent who just wants to do a swap from this chain to this chain, from this token to this token, like, that's straightforward thing. Like, you just place it as a request, and then you get I would say, the quotes, and then basically somebody else is going to execute it for you. So you have a couple of market-making solvers, architectures in behind that can happen on this side. Like, it's about only accessing the funds through the API level of, like, an intent-based system.
Do you know any teams or projects currently working on this specific connection between intent-based mechanisms and AI agents?
Yes, well, basically all the swapping systems right now have some API level access, and right now I'm working on near intents, which is enabling this functionality in Precise.
You mean by near protocol, right?
Near protocols intent system, yes.
Are you currently using it, right, or working to integrate their intent mechanism to your agent, right?
Yes, you can integrate it over the API. There are a couple of ways you can do it. Thank you.
Thank you. I think that was the last question. A big round of applause. And now for our last speaker for today, we have DeFi Nicola. If you don't know him, he's doing the same topic for 3 years now, and I bet he refreshed it to catch on the latest developments in DeFi. So Nicola, tell us what's new.
All right. First of all, thank you for staying up till the final talk of the day, and yeah, welcome to Belgrade. Hope you're having a great time so far, and hope that you're gonna enjoy this talk as well. My name is Nicola. I'm coming from a Block Analytica team behind risk team behind Maker, and the DAI stablecoin, now also USDS. And today we're basically going to talk about latest developments in DeFi. As told during the introduction, this is actually the topic I've been covering for the last 3 years. So yeah, it's gonna be interesting to actually compare the agenda from 24 and 23, which kind of can bring an insight of how at what pace this whole industry is moving. So yeah, today is basically going to be like a comprehensive overview of like the latest developing trends in the DeFi space. On this year's agenda, we're going to cover new protocol iterations. This was also the topic last year, as you can see, but here we're going to focus on the protocols that are relatively new, coming in the last during the last year. But yeah, we're also going to mention some that were mentioned also last year, but may not be launched. Then we're going to head to the DeFi lending innovations, so to put a bit focus on lending protocols and DeFi lending space. Then we're going to move to how basically yield products have evolved in DeFi recently. And then we're going to head to a dashboard that we actually at Block Analytica are developing. It's a stablecoin dashboard covering all major DeFi lending protocols on mainnet. And as the last topic, we are going to cover privacy in Ethereum, which I think has unfortunately been, let's say, sidelined or under-discussed topic recently, and this is my attempt to bring it up to the discussions on events like this, like this kind of conferences and community meetups. We're going to briefly go through a recent privacy project on Ethereum called Privacy Pools. It's relatively small as well, but yeah, it brings some new features on top of the well-known Tornado Cash. And then I would like just to wrap up by mentioning DeFi tools you may consider using nowadays while wandering through DeFi. Okay, so new protocol iterations. Let's start with the one coming from the Instadub team. It's called Fluid, and it's basically a new lending protocol that combines lending and the decentralized exchange. They do it by something called smart collateral and smart debt. Now, let's start first with the smart collateral side. So basically, let's say you as a user want to deposit some collateral to a lending protocol, and you basically say, okay, I don't care if this collateral is, for example, in Wrap BTC or Coinbase BTC. And what Fluid does is basically leverages that fact by using a pair of tokens as collateral, and then using it as a trading pair. So that basically enables you as a depositor of collateral to earn trading fees on top of the vanilla lending APR you can now earn on, let's say, Aave or Compound or protocols like that. So let's go through a simple example. Let's say I put one Wrap BTC in Fluid. and then a trader comes that wants, sorry, let's say I put 10 rep BTC in Fluid, and then a trader comes who wants to swap one Coinbase BTC for one rep BTC. This is done in a, familiar fashion, let's say Uniswap-like fashion. So now my collateral composition is changed from being 100% in rep BTC to having 9 rep BTC and 1 Coinbase BTC, and that is fine. That is fine by me, right? And in return, I kind of get the swap fee from each trader, of course. So the similar mechanism can be applied to the debt side as well. It's called smart debt, and it's kind of a bit more interesting because you can, again, utilize your debt as a trading liquidity, which is kind of cool. But the underlying principle is the same in a sense that a user can say, okay, I don't really care if my debt is in, let's say, USDC or USDT, and the protocol basically leverages that by using that debt in a form of token pair as a trading liquidity. But let's say, the protocol flow of actions is a bit different than from the collateral side. So let's say I generate USDC debt, right? I get it on my wallet and get to use it however I want in DeFi. And then a trader comes who wants to swap USDT for USDC. What the protocol does under the hood is basically it uses the trader comes and wants to swap one USDC for USDT, and then the protocol basically uses the USDC to pay back my debt, and then generates new debt in USDT and get it back to the trader, minus, of course, the swap fee. So yeah, from the UX perspective, as a borrower, you may end up needing to pay your debt in like some proportion of USDC and USDT. So not 100% in USDC. But yeah, in the meantime, you are earning trading fees, which can effectively lower your borrowing rate. But yeah, it's again, from the UX perspective, this can be solved like one step before you actually pay back debt by swapping everything to USDC and then paying it back in USDC fully. Then we, of course, have Liquidity V2. It was already discussed last year here, but has not been launched. Now it's launched and actually relaunched. I forgot to mention at the beginning of the presentation, feel free to scan those QR codes. Those are meant to provide some additional information if you're interested in reading more about the protocols and the recent developments we are going to cover today, because it's impossible to cover everything in 20 minutes. Then we got Euler V2, a new very modular version of lending protocol, alongside with Euler Swap, which has been announced recently. Euler Swap is very similar to Fluid DEX, which we just explained. They're basically keeping all of the liquidity in Euler vaults and then using it as a just-in-time liquidity for trading on Euler Swap. It's actually built on top of Uniswap v4. And of course, Aave v4, it was introduced also last year. It's not still launched, but yeah, some very interesting features are coming up. So yeah, feel free to read more about it as well. When it comes to DeFi lending specifically, there are some of the things that I would say, like in my opinion, are expected to be implemented in newer versions of DeFi lending. The first one being separating LPs into the tranches, the junior and the senior tranche. Now, this is actually a very popular thing in TradFi, right? And this has not been implemented so far in DeFi lending protocols. It actually has been tried But yeah, in my opinion, I think the industry was immature, too immature at the time. So yeah, we'll see if this will work this time. My assumption would be that it would. We'll speak more about this at the next slide. Next up, risk premiums. This is actually also something already available in TradFi, but not yet to be implemented, let's say, on a smart contract level. The mechanism is basically you pay higher borrow rate for borrowing against a riskier collateral, right? So it kind of makes sense, and I think this is actually going to be introduced in Aave v4. Then fixed borrow rates. So currently we have fixed yield thanks to Pendle and some other protocols, and those are based on maturity, right? You have expiry date, and then you need to roll over if you wanna keep like this expected, like predictable yield. So I think this is the next thing we're probably going to see very soon, that those are fixed borrowing rates. My assumption would be that those are also going to be maturity based with kind of automatic rollovers. Next up, composite oracles. This is actually risk management improvement that has been somewhat adopted so far among DeFi lending protocols, but I think it should be it should experience mass adoption because it's effectively like making lending and borrowing in DeFi significantly more secure. So let's give it a few examples. What protocols can implement is basically upper bounds for stablecoins. So let's say, most of the DeFi lending protocols are currently pricing the stablecoins, which are the most borrowed assets, within the protocol by market price. And this actually, let's say if for some reason some of the stablecoins price goes above $1, you can have those highly leveraged positions being liquidated, due to their debt increase. And this is something that can prevent that. So the upper bounds for stablecoins or LSTs, then redemption or exchange rate with market fallbacks. For example, you can use exchange rate for staked ETH and then use a fallback to a market price based on some threshold. For example, a deviation between the exchange rate and the market price, because you don't want to use exchange rate permanently if the crash is real, if it's not temporary, right? You want to avoid bad debt and like this excessive borrowing. Then, of course, different provider fallbacks. Let's say you want to use Chainlink as your primary oracle, and then, for example, Redstone as a fallback oracle or time-weighted average price. Then medians between various providers of oracles. This is actually something, if I'm not mistaken, that Sparkland is currently using, and even some custom feeds for specific purposes. Now, of course, this would be a new code and you need to audit it, but yeah, if it fits the purpose, it's highly advised to use it. We, for example, at Block Analytica did a custom oracle on Base, on a Morpho market for the Lombard BTC, so it's LBTC. We used proof of reserve feed from Redstone and combined it with a market rate. And of course had a threshold being certain deviation between those two, and then made it aggregatable so we can adjust the threshold based on market conditions, of course. The custom feeds do not have to be, of course, developed by you or your team. Those, for a good example of that is Pendle, developing linear discount oracle for PT tokens that are now massively used throughout DeFi as collateral, which is a pretty cool example of how you can cleverly price assets within your protocol and thus create this create more capital efficient environment, right? So basically, those PT tokens are going up to the level of 1, and then basically you can price them similarly, so capital efficiency grows. Yeah, then I want to talk more about the yield products, which I think is a very interesting thing, because the segregation of risk-reward as a product has been tried previously in DeFi and has not, to be honest, seen much adoption. But now we're seeing again this wave of sort of dividing the higher risk and lower risk yield, like the trenching process. A good example of that is the proposed updated version of safety module of Aave protocol called Umbrella. They're effectively adding trenches via staking a tokens, which are like proof of deposit tokens. When you deposit to Aave, you receive, let's say, a USDC or a USDT. And when you stake those tokens, you basically can cover, I mean, you're being exposed to bad debt risk from Aave. Currently, this is done by staking Aave tokens, and this is kind of an improvement in a sense that no tokens need to be sold when in the event of bad debt, but rather a protocol will just burn a tokens that were previously staked by stakers. And in return, stakers are receiving, of course, boosted yield, which is coming from Aave Treasury itself. And yeah, like vanilla deposits, basically another improvement is that vanilla deposits, like if you just deposit on Aave, get a tokens and do not stake it, you get the same yield basically for less risk, because now you are kind of, your risk of covering for the bad debt is lower because the stakers are covering for you. Another good example is a product called Summerfi, which has launched the new protocol with a very simple UX, where they aggregate yield vaults and rebalance between those for boosting the APY. And they basically also have like the high risk vaults, of course offering higher yield, and the lower risk vaults. And yeah, so far it has seen like a constant growth. So yeah, that's why I mentioned, maybe, I mean, I want to just draw attention of the importance of timing, especially in DeFi, when you launch a certain type of product. Also, I think it's worth noting that Pendle PT token looping, which we already discussed, probably even last year, I think it's now safe to say that this kind of strategy is sustainable, that it's keeping up due to various factors, including our ability to keep the borrow rate always lower than the yield of the PT tokens, which kind of makes the strategy profitable all the time. Another factor being that one of the protocols tokenizing some kind of yield strategy, like Athena, adding a mechanism to rebalance between the basis trade, like the core business model, and the yield from treasury bills. So it kind of makes the whole process more sustainable. Then you can also have projects like DeFi Saver, who can build additional features on top to ease the management of those kind of positions, like the automatic rollover to the next maturity, as I mentioned before. And then, yeah, this is actually a stablecoin dashboard we're currently building in Block Analytica. I mean, it's live, and it's actually something we decided to build because we needed something like this as users of DeFi lending protocols and CDP holders and leverage users. It's called Sphere, and yeah, you can basically find a lot of things there, including the net APYs for leveraged positions. Let's say you want to long Ether or Bitcoin. Benchmark rates. These benchmark rates are actually used by Block Analytica when deciding what should when deciding about the adjustment of the DAI savings rate or Sky savings rate. You can also estimate the unwinding price impact of your CDP. You can find the lowest borrowing rates in DeFi. You can see the supported protocols. You can find lowest liquidation prices, and basically even find some trends if you dig deep. Yeah, I think that should be it. Now, the topic I also wanted to draw attention a bit, and I think this project is actually pretty cool. So, privacy pools. It's a new and non-custodial, non-restricted privacy protocol. You can see it as a Tornado Cash, but with one important addition, an additional feature, and that's ZK proofs for which you can use to prove that you are not part of a certain data set or list. Basically proving that you are not laundering money, that you are not hacker that has stolen funds from some protocol or criminal or similar. Important thing to mention is that this exclusion list, so-called, is not centralized like in Tornado Cash. In other words, there are no hard-coded like compliance rules. So anyone can basically define their own list and then prove that they're not part of it. So let's go through a simple example. Let's say a centralized exchange for some regulatory reason needs its users to prove that they are not like malicious actors, right? So they can define their own exclusion lists based on law enforcement data, sanctions list, and basically require your proof that you're not part of that data set. Now, on one end, I mean, it's obvious this is like a improvement compared to Tornado Cash, but still, criminals can still use it for laundering money, as it's completely permissionless and open source. But yeah, they're kind of less incentivized to do it, right? Because if you want to do something with that money, you would kind of need also to provide a proof of exclusion from a certain list. And yeah, to wrap up, I'm just gonna leave this here. Those are basically some tools you could consider using nowadays while wandering through DeFi. So for transaction submission, consider using private RPCs like Map Blocker and Flashbot RPCs. Of course, simulate first before submitting a transaction. For lending and borrowing, yeah, you can use Sphere to find the best stablecoin rates and net APYs. To minimize liquidation and front-end downtime risk, you can consider focusing on protocols, of course, with the proper risk management and DeFi saver automation, which is pretty cool. Of course, use multi-sigs, key rotation, and similar. And yeah, I think we'll have enough time for the Q&A session, so feel free also to ask any questions you may have, and maybe even suggest some more tools that you may have, so everyone can hear. Yeah, that will be it. Thank you for listening.